Okay, so rental income, and it could just be, I mentioned that rental income could include rental of residential rentals as well as commercial rentals. It could also include rental income from personal property, right? Have you ever been to Ace Hardware and they rent out tools and they rent out equipment? So you don't want to buy an edger. You can just go to Ace and rent an edger for the day, or rent a carpet cleaner and that kind of stuff. Other types of large equipment can also be rented instead of actually purchased. So that would include any income generated from that rental would be included in this. This is generally rental income. Rental income received or accrued for the property of real estate or for the use of personal property. It's different from trade or business income. Remember, for Schedule C, we had this income for sole proprietorships. I know that's not the official terminology of it. It's for trade or business. Rental income's a little bit different because it's more passive in nature, right? You're not actually putting effort out to rent it. You're providing an asset for somebody else's use, and you are passively then receiving income for that. Now, obviously, it takes some upkeep of those assets for sure, but it's a little bit different in nature. It's more passive income. So let's see. So what do they talk about here? So if the taxpayer, so we have to kind of make that distinction as well. Is it passive or in nature, or is it actively generated? Because you can have somebody who rents property, but because of the nature of their business, for example, real estate developers or real estate agents, they are in the business of real estate. Now what that does is it changes their rental income from being passive to being active. For most individuals, any rental income is going to be passive in nature, but if it's classified as active in nature, instead of reporting that income on the Schedule E, you're going to report it on the Schedule C instead, and income on the Schedule C is subject to self-employment tax. So it's subject to that Social Security and Medicare tax. Income on the Schedule E is not subject to self-employment tax. So that's a big tax savings. That's 15.3% of tax that you save if the income is actually passive as opposed to it being active. Okay. Rentals are also allowed that 20% QBI deduction that we talked about in Chapter 6 as well. So here's an example. Jack, real estate professional, owns and operates a bed and breakfast, North Carolina. He provides significant services to the renters and has no other trade or business. So as such, that activity is treated as a trade or business, not as rental property. He would report the income from lodging and the expenses on his Schedule C in this example. So like if you have a bed and breakfast and you're fluffing the pillows for the customers or the guests, and you're preparing the breakfast, and you are there helping them, you're doing all the stuff, you're doing the cleaning and all of that. Now you're actively engaged in that, even though what you're officially doing is renting a room to somebody for a night or two. Because you are actively engaged in it, now that changes the nature of it from rental income to income from a trade or business, and it changes how it's taxed. It's going to be subject to self-employment tax, and it changes which form it's going to be reported on. So farming activities have a special category as well. There's a special farm rent form, which is called the Form 4835. You don't really need to know too much about that unless you decide to prepare taxes in Iowa, in which case you will see this form a lot. A lot of people who own farms will rent out all or part of their land for others to farm. Then the income that's generated by the other from the actual farming activity that's the tenant's income, but the rental of that land becomes rental income that is reported on this Form 4835 to the farmer. So we're going to report on the Schedule E proceeds from the real estate, rental of our real estate, as well as rental of other types of equipment is going to be reported on there. And it's kind of like an income statement again. So similar to the Schedule C, we've got an income section on the Schedule E, and we've got an expense section on the Schedule E. Same requirements for the expenses, in that they have to be ordinary and necessary and reasonable in nature, but all of those expenses have to be are reported and offset the rental income. We're also going to be working with depreciation in this chapter as well, because guess what? When you have a rental property, and even if it's a large asset or that you're renting out a large piece of equipment or something, that's a depreciable asset. If you have a residential property that you're renting out, so an apartment building or a home, something of that nature, that's going to be depreciated. If it's a commercial property, that's also going to be depreciated. So we are going to be working with depreciation again in this chapter. So gross rent would be the total rent collected from each individual property. It would include advance rentals in the year of receipt, regardless of the rental period covered or the method of accounting employed. And we've got an example of that here. Advance rental does not include security deposits. So, oftentimes when you rent, say you rent a house or an apartment, you have to put up maybe a month's worth of rent, or first and last month. And that's to cover any damage that may be done to the property. Once you return the property and there's no damage, they then give you your deposit back. Those deposits are not considered to be income unless they're kept by the person renting the property. So if at the end of the lease term, the rental term, they keep that security deposit, then they would include that as income at that time. But when they receive it initially, it's not included as income. So that's one area where it's not really, we're not necessarily using the cash basis of accounting. So if the payment is subject to an obligation to repay it under those circumstances, then it would not be included in taxable income. So here we've got, on December 12th, Della received $7,000 from Philip to cover 6 months of rent from December 15th to June 15th. So this is covering two parts of 2 years here. The payment includes a $1,000 security deposit. So she is going to include $6,000 as rental income in 2024. Even though it's for 2025, the $6,000 that covers all that, because she received it in 2024, that's when she's going to report it, but she's not going to include the $1,000 security deposit. If at the end of that, Philip does some damage to the property and she ends up keeping the $1,000, then that $1,000 will be reported as income in 2025. It'll be offset by any repairs that she had to make to the property, right, as a result of the damage. Expenses paid by the tenant or services provided by the tenant in exchange for rent are also components of rental income. So rental income can be received not just in cash, but also in the form of expenses that the tenant pays or services that the tenant provides. If the tenant pays an expense that's normally paid by the taxpayer has to include that payment in rental income. Also, if the tenant performs services in exchange for free rent or reduced rent, the fair market value of those services would be included as rental income. So another example here, we've got Bill owns a house, usually rents for $900 a month. So when Bill was on vacation, the furnace stopped working. The tenant had the furnace repaired, and they paid $300 out of pocket themselves to repair the furnace. And then the next month, they reduced their payment by $300. So now they just paid Bill $600 because they paid $300 to have the furnace repaired. Bill is going to include all $900 as income, even though $300 of that was in the form of the tenants paying to fix the furnace. But then what Bill gets to do is he gets to go and write off as a deductible expense the $300 repair. Okay, so it's as though he paid the repair. So he's got all $900 is income. Bill is going to then deduct a repair expense of $300 for the amount that the tenant paid. Bill owns a second rental house that is in need of repairs, and he allows a new tenant to live for free, but in exchange, the tenant is going to do the repairs on the house. So the repairs would have an $1,800 value. So Bill is going to include the $1,800 in rental income, but then he's also going to get to write off the $1,800 of repairs. So Bill is even in this situation, but he does have to declare the income part of that, but then he also gets the expense. So same ordinary, necessary, and customary, or ordinary and necessary definition still applies. So ordinary is something that's customary or usual. Necessary is something that's appropriate and helpful as well. It also still has to be reasonable in amount. Let's see. So the same rules for travel and transportation, and that same distinction also applies to rental property. So travel costs from the taxpayer's home to a rental property are deductible if the travel is for the business purposes. For example, some examples of business purposes: to conduct repairs, or to attend a condo association meeting, or to meet with the tenant or something like that, then that travel or that transportation cost would be considered deductible if the taxpayer stays overnight. So for example, if they've got a rental property they live in Des Moines, but they have a rental property in Okoboji. So they travel up there for the day to fix any, maybe they've got to perform some repairs, but it's a long drive. It's 4 hours or something. They don't want to drive back, so they stay overnight. Then that travel expense would also be deductible, as well as the meal. So the same parameters that we used in Chapter 6 for whether something is travel or transportation still apply. If it's transportation, so if it's just he came back the same day, then the meals would not be deductible, right? But if there's an overnight, then the meals are also deductible. You have to be careful if there's any element of personal vacation as well. So those same rules would also apply that we already talked about. Standard mileage rate would be used to calculate those travel expenses. So and it's the same mileage rate as for business miles. Okay, so it's what did they give us? 67 cents for 2024. I can't remember what it was exactly for 2024. I know right now it's 70 cents, something like that. But it's the same as the business mileage rate for this. So it's a business, but because it's a passive business, it gets a little bit special treatment with regard to that FICA tax. And as I mentioned here, because the rental property is not really a full-time job, it doesn't really make sense to depreciate the vehicle, so they would just use the standard mileage rate. They obviously probably would not drive enough to merit using actual auto costs. So some common expenses that are associated with rental properties with regard to rental of real estate. Advertising, so if you pay to advertise the property is open. Travel to and from the property for business is a common one. Repair and maintenance expenses for that property. Insurance, as well on the property. Management fees, if you pay somebody else to manage the business or to manage the property, then that would be something that is deductible. Interest on the mortgage, so if you have a mortgage on that property, you've taken out a loan against it and you're paying interest, that interest is deductible. Property taxes as well would be included. And as I'd mentioned earlier, depreciation. If it's residential, remember we're going to use 27.5-year MACRS straight line depreciation. If it's non-residential, then 39 years MACRS straight line depreciation. One of the things that we have to do is distinguish between what's a repair and what's an improvement. Because if it's an improvement to the property, then that would be capitalized and depreciated. If it's a repair, then it is expensed 100%. And I don't mean like you take 179 on it. I mean, you just get to write it off as a repair and maintenance cost. So some examples of things that might be capital improvements. So if any additions to the home or to the building would be any interior improvements. So this would include built-in appliances. Appliances are kind of special in that they, if they're built in, they become part of the home. And so things like heaters, furnaces, air conditioning units are considered to be built in, and they would have to be capitalized. And they have to be depreciated over a longer period of time as well. Kitchen upgrades, flooring, carpeting, heating and air conditioning systems as well, lawn and grounds landscaping. So if you add a driveway or a walkway or a fence, that kind of thing, add a swimming pool, insulation as well, adding insulation. So these would all be considered improvements and are depreciated. Plumbing system, and then miscellaneous things. So if you're putting in a window or something like that, as opposed to, so an example of a repair would be somebody broke the window and you have to replace the window. That would be more of a repair. But if you're upgrading the windows, you're going from single pane windows to dual pane windows or something like that, then that would be considered an improvement and would have to be capitalized. So it can be kind of tricky to distinguish, is this a repair or is this an improvement? So we've got an example here. Brian in Alabama owns a rental condominium in Destin, Florida. So this has to do with the travel. So twice a year, he drives to Destin to perform general maintenance on the condominium. His round trip mileage is 602 miles, so he gets to deduct. So 2 trips last year, 602 miles at 67 cents a mile. He gets to deduct $807 from his rental income. Let's see. I already kind of talked about this, the distinction between capital improvements, which are capitalized and depreciated over the proper life, or whether it's a repair. So you can, remember, we can't take 179. We can't just write off from rental properties using 179. But there is you can elect to write off and deduct certain improvements up to this maximum, either 2% of the building's unadjusted basis. So that would be what you originally paid for the building. So 2% of it. So, if you paid $100,000 for the building, you can take either $2,000 or $10,000. Whichever is higher of those two, you can expense any capital improvements. If you have rental receipts over $10 million and properties with a basis more than $1 million, those would not be eligible. So that $10 million is probably a little bit harder to get to, but the $1 million basis wouldn't necessarily, depending upon where you have that property or how many properties you actually have. So again, rental, so when you have rentals, the depreciation gets a little bit tricky in that you only depreciate the building itself. Well, most times building is placed on land, right? Condo might be an exception to that, because oftentimes with condos, the land is actually owned by somebody else, or if it's part of like an apartment complex and it's a condominium, you don't actually have land. But if it's a freestanding structure, an apartment complex that is owned, or a house, then land is a portion of that. And the part that you depreciate is only the building portion. So for example, let me erase this. Let's say you purchased a rental home, and you purchased it for $500,000 was your purchase price. Well, included in that purchase was the land that the home sits on. We don't depreciate land. So we have to pull out of that $500,000 the value of the land. Usually what they'll do on like property tax statements is when you get a property tax statement, it shows the tax amount that applies to the building and the tax amount that applies to the land, and it'll give you a percentage. You can take that percentage and apply it to the value of this. So for example, let's say it's 30% of the property is land, and then we got 70% is the building. So it's going to be based on the value, okay? Not the size necessarily of the land versus the house. It's going to be based on what's the value of the land, what's the value of the house. So we have to then divide this up between the two. So 150,000 would be land, and we would not depreciate it. Right? So we're not going to depreciate that. And then the other 350,000 would be the building, and we would depreciate it. So if this is a home, we're going to depreciate it over 27.5 years. So the amount of depreciation expense that we're going to take is going to be based on the basis is going to be $350,000. It's not going to be $500,000. Okay. Obviously, the depreciation is straight line. We cannot take 179 deduction. And the 60% bonus depreciation is only allowed for property with less than a 20-year life. Well, this is 27.5 years, so we can't take that. So we just have to use the straight line depreciation for these rental properties. Now, another little wrinkle develops when we purchase a home. Let's just say that this rental home was included in the home are some appliances. Okay, so we've got a refrigerator, things that if we went out and purchased it, we would be depreciating these items. So we've got some appliances, and we'll say the value of those, we've got to figure out the value of those, $15,000. And then we've got some, what else? Carpeting, and that's worth $5,000. And we've got maybe we've got a swimming pool. Well, we won't do that because I think that's the same length of time. We have some landscaping, and the landscaping is worth $20,000. I will throw some furnishings in there too. Let's say they left behind a fully furnished house. Okay. So some furniture that was worth $10,000. And all of this together, we paid $500,000 for this. What we can do is we can pull out these assets from the value that we purchased it for, and we can depreciate these based on their useful life. Remember, these are different types of assets that are going to have a different useful life. So our appliances are probably 5-year property. I can't remember what landscaping and carpeting would be. Furnishings would be 7-year. So this is like furniture and furnishings. Let's see. Carpeting, we can use 5-year. And we have landscaping here, shrubbery, that counts as landscaping, 15 years. So we can pull those things out and we can depreciate them over a shorter period. What this does is it gives us a higher initial depreciation deduction that we can take. And there's an example here. So here's the method, and of course that's baked into the tables, right? I think they've got an example here. Yeah, here we go. So we got Alan and Cherie Masters purchased a furnished beach house in San Clemente, California, $1,364,000 on June 1st, 2024. Land was valued at $700,000. So most of that is land. We'll assume that maybe it was beachfront property and that's why the land was so valuable. $15,000 for appliances, $3,000 for carpet. I'm sorry, appliances were $3,000, furniture was $15,000, appliances $3,000, carpet $4,000, landscaping was $8,000. They rent the house full-time, so they've got no personal use. We're going to go through the differences between if there's personal use or not, but we'll assume this is 100% used for rental. They depreciate the house in a single lump sum. This is going to be their depreciation calculation. So it would be, so they've got the, what is it, 1, 3, 6, 4, and then we subtract out the land. So what's left is $664 of depreciation for the building, and over a 27.5 year, in the first year, because they bought it, let's see, June 1st, provided they're going to start using it June 1st, let's see. They're going to start depreciating it in that first year, July or June 15th, right? It's going to use the mid-month convention because it's a rental property. So the percentage, if you looked at the tables for starting in June, for the first year, they'd get 1.97% for the depreciation percentage. So in the first year, they'd get to take $13,081 of depreciation. So that would offset their income. $13,081 would offset their income. If, however, instead of doing it in one lump sum, they pull out all of these individual items, this is how it's going to work. So the house would be $634,000. We would pull these out of the house, not out of the land. Okay? So we're going to separate the furniture, appliances, carpet, and landscaping. We're going to pull those amounts, and all of this totals must be $30,000. So this is the house now becomes $634,000 for our basis instead of $664. Furniture, appliances, there's their value based on the useful life, and the percentages that we use in that first year, this is the depreciation that then we would get to take. So it results initially in a higher depreciation deduction because now which is great because these appliances and things, we're going to have to replace those over the years, and then we're going to depreciate them when we replace them, the new items, right? But Otherwise, we wouldn't get to depreciate them this first time, right? Or we would, but it would be wrapped up in that 27.5-year life. Now we can depreciate them over a shorter period of time because we pulled them out individually. The total depreciation that we get to take in this case is $17,290. So you get a bigger deduction by about over $4,000 more of deduction that you get in that first year. So that's the benefit of it. It's going to lower their taxes, right? So let's just say, so their additional depreciation deduction of $4,209, let's say they are in a 25% tax bracket, they're going to save over $1,000 of taxes by doing it this way rather than by lumping everything together. Okay? Also, these items, if it's less than 20 years, you could take the bonus depreciation on it. So the first year you could make it even better, right? Because these are all under 20-year assets. So, and it's the 60% bonus depreciation. Oh, let's see. To do that. All right, so here's what the Schedule E looks like. All right, so again, the same question that we asked on the Schedule C. Did you make any payments that would require you to file Forms 1099? Yes or no? If yes, will you file Forms 1099? So if you paid a management company, you probably maybe did need to file a 1099 and give that to the management company. That would be an example of a time when you should have filed a 1099 for a rental property. So we have 3 lines here, ABC. This is for 3 separate properties. If you have 6 properties, you're going to have 2 of these forms. If you have 9 properties, you're going to have 3 of these forms. So these, if you have a client that has multiple rental properties, these Schedule E's, you could have several of them. Okay? So here on row A is the address of property 1. If we had another property, that would be on B and then C. Type of property listed below. They want to know what type of property. Here are the different types. So single family residence, multifamily, vacation, short-term, commercial, land. If it's royalties, which is not a type of rental, but the royalties get reported on this form as well. So if it's royalties, it would be a 6. Self-rental, so that's if you own a property that you are renting to your own business. This is very common in professionals will do this. So CPA firm owns the building that they then rent to use for their office. Usually what happens is that building is going to be listed under a separate business. And so the CPA firm, even though the owner of both the building and the CPA firm are the same person, the CPA firm pays rent to the building, and so that's considered to be a self-rental, other type there. So the income statement part of this, the income and expenses are listed here. So you can see A, column A refers to this property up here. So that's why there's a B and a C if you had other properties. Let's see. Oh, I skipped over this part. So for each rental real estate property listed, report the number of fair rental and personal use days. So we will, this will be relevant when we start talking about how much was used for personal, how much was used for rental or for business periods. This becomes relevant because it changes what this proportion is, will change how some of these items are reported, how some of the income and expenses are reported. In this case, it's 100% rental, so it's fine. It can go on here. This QJV, that means qualified joint venture. What that is, oftentimes, husbands and wives will own property together. Right? If they've got rental property, they both own it equally. Well, when you have a business for more than one person, you're supposed to report it on 2 separate tax returns. For this, in this case, the QJV, they allow you to report everything together. So if it's a qualified joint venture, then as a married couple, you don't have to file a separate partnership return. So this is kind of a, an out button for not having to file that partnership return. It's the only case when they kind of allow you to do that. Okay, so we've got our income up here. If royalties were received, they'd be listed on line 4 up there. All of these expenses, and just like with the Schedule C, so that depreciation is going to be calculated on the 4562, just like we did with the Schedule C. So that depreciation, and again, the 4562 there's going to be a 4562 for rental properties. There's going to be 4562 for Schedule C property as well. So those would be separate. And then all those other ordinary necessary expenses. Everything is kind of combined down here. If there is a rental loss, like if all of your properties combined together come to a loss, depending upon what your AGI is, you may or may not get to take up to $25,000 of that loss, but it's limited to $25,000. If your AGI is over, I think it's $150,000, you don't get to take the loss. So, but you do get to offset gains on one property and losses on another property. So it's your overall gain or loss. But there are restrictions on passive losses. But if you get to take a loss, it's just like the loss for capital gains. It's going to offset other income on your tax return. Okay. There's our depreciation. Again, same form. We already went through this, 4562. So this is what it would look like for that example, where we've got the 5-year property. This is, first year depreciation. So that's why it's going to be here rather than prior on that line 17. So here's the building. Here's the landscaping. Here's all the other stuff and the depreciation for it. And then there's the total, that's $17,290, which then gets transferred over here to the Schedule E, $17,290. Oh, let's see. This is page, this is the listed property. This is the 4562. Sorry, I thought this was page 2 of the Schedule E. We will look at page 2 of the Schedule E when we talk about the income from the pass-through entities, because that's where that income is reported. So as I mentioned here, there are potential limitations on the deductibility of losses. 179 cannot be claimed for property held to produce rental income, but you can take the bonus depreciation, but only for assets that have a 20-year or lower useful life. All right.